Hello, everybody. This is Alan Ellman, the Blue Collar Investor, and welcome to this BCI podcast number 129, titled Analyzing a Rolling Up Covered Call Trade. We're going to be using a real-life example with Sinclair Broadcast Group, Inc., which trades on the NASDAQ exchange under the ticker symbol SBGI. Let's start by defining what is rolling up with covered call trades. Well, certainly it is a covered call writing exit strategy, one that we use frequently. And that's where the current short call is closed or buy to close, and another is open, sell to open, at a higher strike price. Now, we could roll up in the current contract month or a later contract month. When we roll up in a later contract month, it's called rolling out and up. And that's where we actually use the rolling up strategy most frequently, when we roll up in the next or subsequent contract cycle. And we typically use this strategy when the share price has gone up substantially. Now, in today's podcast, we're going to be showing you a real-life example with SBGI that was shared with me by a member of the BCI community. And we're kind of going to analyze it because there are certain aspects of this trade that we may want to improve upon. There are others that we may want to keep in our arsenal. So here we go. On December 14th, 2020, 100 shares of SBGI was purchased at $28.19. From a covered call perspective, we are now covered. Immediately after the purchase of the shares, the option was sold. The January 15th, so about a 1-month expiration, 2021, 29 out of the money call, out of the money in relationship to the $28.19 purchase price, was sold at $1.70 per share. Now, on January 4th, with 11 days remaining to contract expiration, the 29 call was closed, buy to close, at $3.50, because the price of the stock had gone up to over $32, $32.16 at the time that this BCI member sold the shares. So first, the 29 out of the money call, which was now in the money, was bought back at $3.50, and then the shares were sold at $32.16. Well, immediately after selling the shares, they were purchased back at approximately the same price, $32.15. Well, I think you can all see as you're listening to this, there was really no reason to sell the shares, but that's what was done. Now, once those shares were again owned, we were long the stock, then a new option was sold, and the 29 call that was recently closed was rolled up to the 32 call at $1.35. So it was rolled up from 29 to 32 with 11 days remaining until contract expiration. So let's let all that information settle, and now let's evaluate the trade. Let's start off by looking at the initial calculations using the BCI Elite Calculator. Once again, remember, these are 1-month initial time value returns. You could see, for those of you also watching this podcast, on the left side of the spreadsheet, we enter the price of the security at $28.19, and the 29 strike was sold at $1.70 with a 1-month, 1/15/21 expiration. Now, once those cells are filled in, on the right side of the spreadsheet, we get our return on our option, or RU, the initial time value return, of $1.70 on a cost basis of $28.19, and that converts to a 6.0% 1-month initial time value return. But when we sell an out-of-the-money strike, there's also an opportunity for additional share appreciation from current market value, $28.19, up to the out-of-the-money strike, $29. and that represents an additional 2.9% 1-month return. So the maximum return in the best of all situations is an 8.9% 1-month return. Now you could see from these numbers that the security is a fairly volatile security, giving a 6% 1-month return for a slightly out of the money call and the possibility of another 2.9%. So we're dealing with a fairly volatile underlying security, appropriate for some and perhaps inappropriate for more conservative investors. So there's no right or wrong here. I'm just sharing the fact that we're dealing with a security that has a fairly high implied volatility. So that's where we stood when the trade was first entered. Max return 8.9% for the 1 month. Now let's move on to the fourth, where the actual 29 call was closed. So we're now going to use the Unwind Now tab of the Elite or Elite Plus calculators. That's where you'll find that tab only in those two calculators. And if you look all the way to the bottom of the spreadsheet, and for those of you just listening, I'll describe it for you. It turns out that the actual time value cost to close with 11 days remaining until contract expiration is 1.21%. So from that 8.9, you would deduct that amount to close the trade. Now, the question that we ask ourselves when we're using this strategy where we close the trade, if we were doing both legs or the mid-contract unwind exit strategy, is can we generate 1% more than the time value cost to close by the end of the contract or in 11 days? Let me state this differently. Can we generate at least 2.21% in the 11 days remaining until contract expiration? Probably not. Okay, so that's where the trade was half closed. The short call was closed and the share value now moved up to the current market value because we no longer had the short call in place. All right, let's move on now because there was a second trade executed by the BCI member where now the stock price is 32.15 and the 32 near the money, slightly in the money strike was sold at $1.35. So we once again put that into the multiple tab of the Elite calculator, and that will tell us that we have a time value return of 3.8% and a very tiny bit of downside protection of 0.5%. So once again, now we have an additional 3.8% return. So now let's analyze the trade in its entirety and see if we can make some sense of this. So the initial trade had a max return of 8.9%, and that was represented by the 6% for the initial time value return, plus another 2.9% if the price of the security went up to the 29 strike, which it did. It went up and beyond. So that's where the trade stood on January 4th when this rolling up exit strategy was executed. Now, when the short call was rolled, there was no need to sell the stock for 32.16 and buy it back for 32.15. That step could have been eliminated and had the same results. Now, I want you to realize this, that at the time when the rolling exit strategy was executed, the original 8.9% max return was protected from the current market value of 32.16 down to that 29 strike. In other words, if the price of the stock dropped all the way down another $3.16, we still would have realized that initial 8.9% max return. So we had a really juicy 1 month return with some very significant downside protection on January 4th. Now the calculator, when using the Unwind Now tab, showed a cost to close of 1.2%. So that's automatically deducted from our initial max return. Now, rolling the option ended up with a debit, right? It cost $3.50 to buy back the 29 call and generated $1.35 sell to open the higher strike price, the 32 strike. So that resulted in a net debit of $2.15. But we also had some unrealized share appreciation as a result of rolling. When the original 29 call was in place, that's the most our shares could be worth at that point in time. But by buying back and closing that 29 call and rolling up to the 32 call, in essence, we had a $3 of unrealized share appreciation. So when we factor that in, we had the plus $3 on the stock side, unrealized as it is, minus the $2.15 net debit by rolling the option, and that created a positive 85 cents per share by rolling up in the same contract cycle. Now, this additional profit depended on SBGI remaining at or above the $32 strike price. It was just slightly above with 11 days to go. Do we want to risk the share price staying at 32 or remaining above it in the last 11 days and risking that original 8.9% max return? My preference, when the stock moves up and the option value approaches zero, which was not the case here because it cost us a 1.21% to close. But when it does, we want to close our entire position and enter a new one with a different stock that will generate at least 1% more than the time value cost to close the original short call. In this case, 2.21%. With 11 days to go, I would vote no on that one. So, summarizing everything, on January 4th, 2021, no action was needed. And the reason is we have a max return of 8.9% and significant downside protection of that 8.9% rather than adding another 85 cents profit, but yet being in a situation where that can easily go down below that 32 strike. When the price goes up significantly, frequently, there is profit taking and we're creating a riskier trade. So I say on January 4th, and some of you may disagree with me, but from my perspective and in my humble opinion, at that point in time, I would take no action. Now, before I go, as I always mention, this product we're very proud of, the BCI Package. It is our best and most comprehensive educational product ever offered by the blue-collar investor. There are 18 components to it, and the one of those 18 components has another 200 plus components to it. We have 6 online video courses with downloadable workbooks, 6 calculators invented by the blue-collar investor and found nowhere else, 5 of our best-selling books in ebook format, and our premium membership, which is 13 months of membership where you get all the reports of the eligible candidates. Plus, you also get our training videos. Right now, there's over 200 of them, and we add one new one every month, along with other files and resources, including expanded calculators and free ebooks, all part of the BCI package, which just log into our website, thebluecollarinvestor.com. Click on the BCI package link at the top of the web pages for more information and get this entire package at a 25% discount. You can also purchase all of our products individually by going to the bluecollarinvestor.com store, where we have video online courses, ebooks, physical hard and soft cover books, calculators and spreadsheets, and information on our one-on-one coaching program. So ladies and gentlemen, there you have it, our BCI podcast number 129, analyzing a rolling up covered call trade. Folks, I hope you enjoyed this presentation. And most importantly, I hope it puts cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.